It goes by itself now.
It's dangerous.
Totally. I'm going live on Instagram.
Cool.
All right.
We're alive.
Are you good?
I think so.
All right. Welcome to a new episode of Raw Take for CEOs. Today we have Korey back. Stephen Byler is on vacation for a couple of days with his family. So this is Startup Month.
Mm-hmm.
We've been kind of talking through some of the issues and opportunities that founders and scaling startups have. And so April being spring, so springing into Startup Month.
I like it.
You like that?
That's
nice. And today we have a special guest. We're excited. Ari Palmer from TaxTakers, good friends of ours. They're experts in R&D tax credits, and they've got a really great platform that some of our customers have actually taken advantage of. Because the reality is a lot of the data that goes into preparing and doing the R&D tax credit study is actually housed in T-sheets, time cards, QuickBooks, et cetera. And it's a great opportunity for companies, especially those that recently started, less than 5 years. If they have payroll, they can take advantage. You don't actually have to make money per se, income, and actually use it towards your income tax. So
it's something that's I think people hear about a lot in the startup community, but kind of are either just kind of don't really attack it because they don't realize how much money is really on the table, or they just don't know how to attack it. So TaxTaker will kind of go into detail on how they kind of take some of that pain off the table.
Yeah, and before we bring her on, two kind of interesting articles that we picked up this week. One has to do with startups and sort of the amount of money that's just funding startups, especially in Q1. I think last quarter may have actually beat the prior record, which was sometime in 2018, maybe Q4, Q3 2018. And then the second piece of news that we've been talking about, I'd say for the last few months, because a lot of our customers are really seeing this. This is like
we're seeing it.
We're seeing it. I actually, speaking of us, I was just on the phone with our friends at Acuity down in Atlanta. We talk to our competitors. We're all friends, and they're saying the same thing. It's the job market is tight, even though the numbers aren't showing it. So the article, the title of this article is "The Job Market is Tighter Than You Actually Think," and I was like, spot on. So Korey, why don't you talk to us a little bit about Silicon Valley's deal machine is cranking? I've never seen this frenzy before.
I mean, it's kind of funny looking back at where we were last summer, kind of everything drying up, right? And now first quarter of 2021 looks like startups raised $69 billion from investors, which, as you just mentioned, beat the last fourth quarter of 2018, which is a previous high.
What was the number?
It's about 41% more. So it's
69 billion, right?
69 billion for Q1 2021. So it's about 40 billion roughly for the last high.
Right. So, but you think about it. So last week, Steve and I talked a little bit about cryptocurrency. We've sort of stayed away from that topic. I know you and I enjoy a little bit of cryptocurrency trading. We don't do day trading. We're there for the long run. But even the value of Bitcoin and cryptocurrency has doubled just in the last 70 days, right, from January to March. So it is probably a little bit of this like risk on, risk off trade where interest rates are historically low and everybody's like hanging on to those stimulus checks.
I think when thinking through this, reading through this, I feel like that's actually ironically like maybe a major piece of kind of some of this fundraising is like you have volatility in, say, cryptocurrencies or other asset classes. Are investors really just going to startups because it's ironically more stable?
There's big opportunity when you see companies like Clubhouse going from $1 billion valuation, which is crazy, 10 months ago, to $4 billion in valuation most recently with their raise. Or even if you look in our industry, again, conversation I was having with Blake Oliver over at Giraffe was about Pilot, right?
Yep.
And how Pilot goes from even a couple $100 million valuation in our business is is absurd. I get it, there's a technology play there, but if you look at history with some of the scale factor and other sort of tech-centric accounting, scale factor, we know some of the issues that pilot raises $100 million, and yes, Jeff Bezos, I'm sure, is like preferred status on that raise. He's definitely going to get all his money back, kind of thing. But hitting $1 billion valuation for essentially an accounting firm that, you know, the rumor mill has 1,000 customers, even if it's 1,500 customers or even 2,000 customers, let's stick with 1,000 customers, you're still looking at 80 to 120 times revenue. That is crazy.
Even for a tech company.
To bring that back down to earth, say to a normal trade of 3 to 5 times or even 10 times, like you're gonna have to see some major growth in that business over the next 2 years. So valuations are obviously popping. You're seeing money flowing. It is a risk on, risk off type of trade. Interest rates are low. Stock market all-time highs. There's probably a lot more risk. And so when we talk about risk, let's start talking about one of the biggest risks to our economy, which is the labor market. People, right? So here's the headline, right, guys? So total unemployment, like total employment jumped in March. Okay, it's expected, right? Businesses are opening up, but it's still down 8.4 million from the pre-pandemic peak. That's 12 months ago. There's still 8 million people. It's lower by 8 million, and that's on par with the worst point of the 2007-2009 recession. So even though we've recovered and we've seen a nice upswing in the labor market, at this point, we're still at the lowest point we were in the 07-09 recession. And, you know, while then the article goes on to say, you know, while unemployment rate is still at 6% or still 6% lower than the 2009, it is above 9% when people not counted in the employment line. We're seeing this today when we're having conversations with potential candidates. One of the first words out of their mouth is, well, can I do the job from home? I'm like, what do you mean, can you do it from home? Like, yes, it can be remote, but, you know, we're still a company. We still need to come together. And it's like, there's a dichotomy in the labor market. We touched on this last week. And people are afraid.
People are afraid. I'm really curious to see that data broken out by industry, because I feel like it is, you know, just listening to peers, listening to people, there's certain industries that people are completely avoiding, like the restaurant industry, hospitality. They just don't want to. You can't do that remotely, A, and B, you are in front of random people the entire day.
The entire day. And so anecdotally, so the article goes on because some of the economic readings that are out there, Beige Book, et cetera, it's not just all data, right? They do take sort of commentary from businesses. So here's an example. A landscaper hires 20 laborers in February and nobody shows up for work. Restaurants offering $1,000 retainer if new employees hang around for more than 3 months. Crazy times. And so, you know, we're talking about twofold. One, pressure, like there's 2 types of pressures in the labor market, and I don't think the second one is yet to show its head. First is there's a shortage. And what's available, you're probably poaching from other competitors or other industries, or you're trying to really convince people with a high level of anxiety to come back to work to take that risk. Secondly, the biggest risk here is I believe in the next 6 months, we're going to see wage price pressures. And that's going to put pressure across the board with stimulus. And there's still stimulus coming at us. And with these risks, you sort of ask yourself, do we really need more stimulus? Like, do we need more economic activity when the pool of potential employees hasn't really changed? Like, you're not having more people coming into the labor market.
Back to work.
You need to get people to come back to work. But the way you do that in this case is vaccines. Decrease that anxiety, because the labor pool is not there because there's a very large, I'm talking 8 million people that are not actively looking for work. They're okay being at home.
Part of it though is the vaccines, but let's be honest, the other part of that is the ongoing extra unemployment money. Like you can take both sides of this, right? Even if you are vaccinated, we have seen from applicants, people that are fully vaccinated that do not want to come back in either way, right? I know people that are just simply not looking for jobs because they make more money on unemployment.
That too.
How are you supposed to be incentivized to come back?
And so as businesses reopen, the article goes on to say, as businesses reopen and stimulus checks juice sales, the demand for workers is now recovering, but the supply of workers, not so much.
Mhm.
So anyways, with that said, I think those are,
Could talk all day long.
we could talk all day about this because this is real, whether you're in the service-based business, construction, medical, hospitality, restaurant, like this is a real issue. And the article ends it here. This whole situation, this is where politicians really need to like take note. This really undercuts the rationale for the aggressive fiscal and monetary stimulus being injected into the economy. Because all you're doing is adding more fuel to the fire and really creating inflationary pressure. So
we can't turn a blind eye to this because
No.
it's just gonna hit a point where we break.
Agreed. So let's bring Ari on. Why don't you go ahead and bring her on? And we're going to talk R&D tax credits. Our startups, a lot of our startups know about R&D tax credits, and many sort of don't. Right? There's just so much going on. So. Good afternoon, Ari, or good morning. I know are you in Austin today or are you in?
I'm in Austin, so almost the afternoon, but.
Cool. So TaxTaker, tell us a little bit about yourself and a little bit about your company.
Absolutely. And thanks guys so much for having me. So happy to be here.
Totally.
My name is Ari Palmer Salafia. Still working with that name, was married a few months ago. So can't quite drop the Palmer, but not ready to be one of those hyphenated folks. Sorry for anyone who is hyphenated.
That was me growing up, so I feel
it just doesn't feel right.
Are you still hyphenated?
No. I can solve it.
Yeah, but I'm trying to embrace the Salafia Italian name. I do love it. So it's just an adjustment. So yeah, I'm in Austin, Texas, originally a Californian. Another Californian moves to Texas. It's pretty popular story now, but I did move in 2016, so I feel a little bit more like an OG.
But you're ahead of the curve.
Yeah, I'm ahead of, trendsetter, if you will. And yeah, so my company is TaxTaker, and we're helping companies better claim research and development tax credits. I've been in this space for almost a decade. It was actually the reason why I moved to Texas, was to expand my father's tax practice. He's been doing tax incentives over the last 40 years. I've been dedicated in the R&D credit, and in 2016, it became a permanent fixture of the federal tax code, which really meant two things. Accountants and their clients could better plan around the incentive. They didn't have to wait every year. Is this going to be around again? Should I be thinking about this? And then secondly, the code was enhanced for companies of all sizes, particularly startup companies. But where the rubber wasn't quite meeting the road was that it's difficult, especially for small companies, to take advantage of this incentive, especially when you've got specialized experts, whether those be tax attorneys or CPAs or engineers. So we built TaxTaker to be that bridge so that any company, regardless of where they are, if they've just started or if they've been around for a long time, can better access the credits that are available to them. Because every founder's got a whole swarm of priorities, and they want the money, but they don't want to have to spend too much time to do it. So that's what we're all about.
Yeah, and that's why, we're excited to be able to partner with a company like TaxTaker, because, a company like ours, we do have access to a lot of our customers' information, whether it's the time cards, the payroll, the actual underlying accounting, the allocation. Talk to us a little bit about how you work with customers, the technology, the portals.
Yeah, definitely. So we're intentionally built to play really nicely in the sandbox with the company as well as any of their advisors or systems that they're already using, so that we can kind of just be the expert in this one piece of their tax return. So our dashboard allows for collaborations on kind of any side of the house. Whether it's they need help, they want their accountant or CFO or kind of finance person to contribute to some of the information, or maybe it's part of their team that oversees their projects or their product development. So we're really looking for a couple of different things from the client. One is kind of the financial information. So we pair with Gusto, since most of our startups use Gusto, although we are totally payroll neutral. If anyone's on a different system, our software accepts it, runs through it, analyzes what's qualified, and that helps us calculate the credit. And then the other side, we're collecting documentation. So definitely want to go into why that's important at some point on the call.
You take a look at the R&D tax credits, and they hear about it, people tell them about it, but they don't really know what that means. My CPA doesn't do it. I don't know where to start. It's like, for some of those people that are listening, like, who is qualified? And I know there's like a slew of different things, but can you give kind of some of the listeners like high level?
Yeah, and is there a minimum threshold?
Yes, great questions. I'll touch on both of those. So just the broad definition of the R&D credit is it's available to any company or company of any size that's developing or improving upon products or technologies. That also encompasses processes, inventions, software, formula, et cetera. But basically, if you're building something, you likely qualify. The code then gets a little bit more granular and says, all right, now your activities need to be based in the hard sciences or computer science. But the definition still leaves so much broadness intentionally so that sub-industries qualify. So we have, life sciences and technology and manufacturing and engineering are still the largest claimants. We help companies that are in CPG to robotics to crypto and blockchain. And the common thread, right, is that they have just technical type personnel developing new or improved things.
Right.
On the CPG side, right, everyone wants a chip that tastes like a Ruffles, but is non-GMO and gluten-free, and that there's food science there.
Right.
Similarly,
so when I hear like breweries and like companies making new brews or new formulas, that would qualify, right?
Definitely. All those formula developments, and that's highly qualified. So distilleries, wineries, breweries, they go through all different types of kind of mechanisms, and they're always experimenting, and there's trial and error across their whole year with different varietals, or even to their packaging, what can maybe extend shelf life without compromising the quality of their beverage.
Cool.
So there's a lot of things companies that have to spend a lot of money and time on.
Yeah. So one thing I hear a lot is, well, I'm a startup. I'm not really making money. So how can I actually?
What am I offsetting?
Yeah. What am I offsetting? How can I take advantage of the R&D tax credit? Can you help us understand like how that all works? Like, how do I actually get my money?
Definitely. And this is one of the biggest reasons why companies don't take a look at this, is that for that reason, I'm not profitable, or I'm pre-revenue, or I don't pay tax. Why would I think about tax credits if tax is not in any form or fashion a part of my business, and it won't be for years.
Right.
But when the code became permanent, Congress realized that there was a gap in the market for a lot of eligible companies, particularly young startup companies. So they made a rule that any company that is less than 5 years old, that has $5 million or less in revenue, can actually take advantage of these credits as a payroll tax offset. So what that means is if a company has any salaried folks, no matter what employer you are in the country, you have to pay FICA tax on your employers, just the way employees get that taken out of their paycheck.
Yes.
So every employer is paying 6.2% on every single employee. And the R&D credit can actually eliminate that liability. So it can be a nice ease of cash flow in the near term until that company reaches profitability or surpasses that cap.
Got it. And so my last question on this topic is, so how does a company actually access that 6.2%? Do they just not withhold it or pay it or remit it? Do they get it as a refund at the end of the year? Like, how does that mechanically work? Assuming that, it's April 21st, right?
Yeah. So the first step is have a conversation about your qualifications and your eligibility and see what's on the table based upon 2020, right? So hopefully if you haven't filed your return yet, you've got a little bit of time to figure this out. So we're talking about what the expenses looked like in 2020. If we were to add up all the eligible expenses from 2020, that would yield a credit. And let's say a company is eligible for $50,000. They would apply for the R&D credit within their tax return. That's always reported. It's a form called 6765. Every company that claims R&D credit does the same thing. They file this form, but there's a new connecting form that ties the tax return to their quarterly 941s.
Got it.
Depending on so it's kind of funny because we're looking at last year's numbers, and it's kind of a go forward refund, if you will. So depending on the payroll provider, you're going to continue to pay in your payroll taxes. And then typically you're going to get that refund the quarter after in which you file. So you'll apply that, you'll give that form to your payroll provider, and they'll make that process for you. Gusto's made it a little bit easier if you want to opt into a real-time option. Once you give them that number, they're going to actually reduce it on a per pay period basis. So you can get that relief as soon as you give them that form. But typically,
it adds up. Number, right? And for companies, labor is a big chunk of it. Now, you said a key point, it's all about the employees. Now, how about if someone has overseas employees? Does that count?
Yeah, unfortunately, it does not. We know talent is global, and especially for startup companies, there's just a need to use distributed teams, especially at the get-go. So that's not going to disqualify you, if you have a mix, but unfortunately, we can't include those folks as an expense. We would include, the folks that are here overseeing those folks. A big kind of catch question we get to that all the time is, well, what if I pay, a US-based agency, the money's here in the United States, but who knows where those folks actually are? You've got to know. And if there's even kind of a breakdown between maybe they do have some US folks and maybe some are overseas, because if you were to get audited, those overseas costs would be adjusted. So
it can't be used for 1099ers, right? It has to be used for W-2 employees.
So actually, that's a great question. So it can be for 1099s if they're US based. So the largest kind of yield, the way that the credit is calculated is based upon W-2 wages. But the next bucket are those 1099s that are US based, or even shops, maybe, be to the point of the CPG or the brewery company. Maybe you don't need a food scientist all year long, but they might need them for some projects across the year. So they're going to go get that resource and pay for that resource, maybe just a few months out of the year. They can absolutely include that expense if they're US based.
Include the expense, but there wouldn't be any offset for payroll because there is no payroll taxes.
Right. So the W-2 wages, the contractors, if they're in a physical kind of space, they've actually got a physical product. It might be some of the materials consumed to get through their prototyping phases. And if they're in a software space, maybe some of their cloud costs as it relates to their testing and staging environment. So things like AWS, Google Cloud, Heroku. So if we were to add up those 3 to 4 categories, we would then get the resulting credit. That credit is going to offset the FICA tax for the startup.
Got it.
The contractors, potential supplies, cloud, and W-2 all yield the credit, but the credit then is going to just be applied to the eligible FICA taxes.
Cool.
Or income taxes if they are in a profit.
If they have profit. Do you have anything to add? So let's talk a little bit about, so one of the things that gives companies, especially startups, a little bit of, you know, like an issue with R&D tax credits is like the documentation piece, right? You know, I mean, let's face it, getting some of these founders and startups just to stop to think about some, you know, important compliance like tax filing or an HR thing, or, you know, or cash man, you know, they're just moving rather quickly, and they're, you know, thinking about fundraising, product development. They're thinking R&D tax credit, it sounds like it's going to be kind of a pain in the ass. Do I really want to expose myself to that risk? Do I need, you know, how do you go about that process to make sure that it is ironclad, right? It is auditable, because that is a concern for companies.
Definitely. We talk a lot about this as an organization because we want to, you know, minimize the friction for these founders to get their money, you know, in the fastest way possible, but also be cognizant that whenever you're putting any kind of credit on a return, there's always a chance of audit. And as an organization, and, you know, being reputable and getting most of our referrals and trust from CFOs and CPAs, we need to make sure that the documentation is behind the numbers. So how do we do that? As an organization, we get a good idea during the discovery call, that kind of initial chat with the founder about what systems they're using, because we want to learn what the fastest path to gather the information is. And in most cases, the information's already there.
Right.
It's not like they have to recreate anything. Although I have seen companies have to recreate documentation. That's definitely painful. But you know, if they are creating user stories and they're doing technical roadmaps and they're using, or they have any type of project management or any type of schematics, like they can just shoot those right over to us. They're already there. Then we're going to have a quick conversation around who was involved. We actually pared back our technology a bit in the documentation phase, because we realized that just from founder feedback, they'd rather have a quick chat about it. They know where some of those source files are, or they can give us access to those. Would rather just do that and then have a quick conversation versus, to your point, like figuring out all these things they need to put together and writing about it. It's too much of a time suck for them.
Yeah, especially if their environment isn't about capturing time. Like if you go to an R&D shop, or a shop that has had both, you know, some non-dilutive funding like grants, especially university transfer type of companies, they're used to tracking their time and putting notes into time cards, hopefully electronic time cards. But many of these startups, even high-tech startups, you know, they got $1 million in the bank. It's like off to the races. They're hiring and hiring. And yes, they're hiring all engineers behind the scenes, but nobody's really
just adjusting on the fly.
They're just adjusting on the fly, right? They're not thinking like, hey, we need to take notes on what we just did this last 2 hours, right? For a tax credit. So,
right. And you know, project management systems are great and time tracking can be great, but it's only as good as the users that use them. And you can have 2 engineers effectively doing the same role, but they might log or kind of track their time very differently. So sometimes folks laugh when I call the IRS reasonable, but they actually realize that time tracking can be flawed. It's a great indicator, of contemporaneous documentation, but they do allow for reasonable estimations of individuals' time. So the number one reason why credits get adjusted, or in the worst case scenario, disallowed, is lack of documentation. The next is lack of nexus, or the ability or inability to tie personnel to the projects that they worked on. So typically, we have certain levels of management, even at a young company, and maybe it's everyone. It's fairly easy to identify who's doing what. Maybe it's not perfect, right, of daily, but in many ways they can zero in on immediately what features or projects that they're working on. And
especially if they have some sort of agile system or product management system. So back to my one of my questions about minimum threshold. So what is that, what level of expense does it make sense to actually go through this process with a company like yours versus spitballing it on the form yourself?
Totally. So we don't like to say that we have minimums, but at the end of the day, if a company doesn't have any salaried individuals, it's not going to make sense for them to take advantage of it. It could if they have a lot of contractor expenses. Let's say they just raised, their pre-seed or their seed round here in 2021, but last year they had a lot of contractor expenses to get the business up and going. Maybe it's that we do want to calculate a credit on 2020 because they're about to have payroll, right? But typically we want to see at least one or two individuals on payroll, because that usually equates to a little over 100,000 in credit, because the net kind of effect, the way the credit is calculated, is about up to 10%. So in that regard, founders, like, for sure, at $10,000, I'm willing to spend some time on this.
Got it.
And we've got companies that get as excited around, $9,000 or $10,000 just as much as they do around a few $100,000. You're right, especially because just every dollar counts from the get-go.
And how about timeline? Is there a specific timeline when people should be thinking about this? Should they wait until a few years out, or right up front, or?
Yeah, so we always say, you should be claiming the credit, or at least looking at this for every year that you're eligible. It's important to at least take a look, because if there is any benefit on the table, you can't go back actually and claim the credit against payroll taxes. You could go back and amend your return to account for future income taxes, but that's just kind of extra work. And we just like to have these conversations as early as possible, because it's much easier to say, all right, looks like you are performing qualified activities, but it's not going to be material enough until this next tax year, versus, why didn't anyone tell me about this? I've left how much on the table? Those are just way more painful conversations to have.
So back to kind of maybe your original question. So let's say I go back 2 years and let's say 2019, 2019, and there were significant innovation being performed, and I had 4 folks on staff on payroll, and but I didn't realize I knew about the I didn't know about the R&D tax credit. I didn't understand the benefit. In other words, I left money on the table. What can you do for that company? If you could help me walk through that process,
Yeah, definitely. So in any event where a company, might have missed out on a year, the federal statute allows us to go back 3 years on a company. And as an unprofitable C corporation company, you can actually go back to day one. So those are really fun projects we've done where you go many, many years back. But that's kind of a whole nother kind of scenario. But let's just say there's some credits on the backside. You're allowed to go back to generate a credit. It would require amending the tax return just to report the credit. If there's refund opportunity, you quite literally would process that, and the IRS would send you a check.
right.
Let's say you're an unprofitable startup company, you would bank the credit for future use. And the neat thing about this is it's an asset on the balance sheet. So it's not if you don't use it, you lose it situation. These credits carry forward for 20 years, which is kind of a lifetime, right? Especially when you're talking in the startup space. We've seen some really unique examples, particularly in kind of the heavily VC funded areas in the country, where companies see the value in banking those credits, maybe because they know that a majority would transfer in a sale to the acquirer as a C corporation, or as a pass-through. That's going to limit those capital gains that you might owe during a transaction. So it's just a highly strategic incentive that really should be evaluated every single year.
But the key point here is I cannot take advantage of those tax credits from 2019 and apply it towards my payroll in 2021 because it's too late.
Yeah, it's a rule on the amended return. We hope that changes for companies because they don't hear about it for a few years sometimes. Yeah. Also hope it improves that these companies would just get a lump sum check there's a lot of bipartisan support. So I hope some members of Congress hear this at some point.
Yeah, definitely. So if there's one thing I'd like to change topics and spend 5 minutes on a new topic. But speaking of sort of evangelizing and marketing, you've done an amazing job of marketing. So I'd like to kind of maybe spend 5 minutes on some of your learnings around digital marketing and marketing for your own firm. You've obviously recently rebranded your website. You're very vocal on LinkedIn. Our companies, with other companies, we do networking events and we try to stay close on a referral basis. I'd love to learn a little bit about your evolution on the marketing side. So let's put R&D tax credits to the side for just a second.
Would love to. Believe it or not, I
like that is a passion of
other
ours
things
here, right?
besides R&D credit. Yeah. And truly kind of the motivation behind kind of these other spokes that I just enjoy is just because the startup community is so fantastic and there's so many things to do, and it's kind of natural to want to empower this community of kind of brilliant doers. So my kind of marketing and sales journey evolved from kind of the old school way, right? Of I used to be the just cold caller and cold email outreach person, and I was trying to knock down on doors of essentially kind of older gray-haired CPAs.
Right.
And that's kind of how I got my start, was just building value and trust within organizations through partnerships. And then that's evolved and has kind of created a network effect. So definitely appreciate all those older school relationships because they've eventually kind of evolved to enable me to be able to kind of play a little bit better in the digital space. But partnerships and kind of networking groups have always been something that I've always seen value in, especially when we're all talking to the same people anyways.
Right.
And as far as the R&D credit goes, it's more likely than not that before I get off of maybe a discovery call with a founder, they ask me, what else should I be looking at? So that really told me something, right? So that made me realize, all right, well, I have about 12 other things that I could tell you that would probably be important for your business. So why don't I hook you up with those folks? And that's kind of that's what's really informed kind of our organization's marketing strategy, because our mission is to support these companies.
Yeah, it's an altruistic way of expanding your marketing. I just want to add one thing. We marketing, like the success of marketing is obviously ROI, it's conversions, it's closing that sale. But once you get that rhythm, what I'm hearing from Ari is, how do you make marketing scalable? In the days of like knocking on doors, shaking hands, making that one-to-one relationship, it's very linear. I mean, it's great. I miss those days, bellying up to the bar, having a beer with a friend, and really building those. But I've never met you in person. We met last year in the middle of the pandemic, and we've had a few networking events and quite a few conversations. I'm excited for this sort of version, whatever the hell version we want to call this, COVID version of marketing.
That's what I was going to ask is like how over the past 13 months you've kind of, have you taken a different approach? How have you shifted that strategy of like talking to people?
Yeah, I definitely have. I've had to. And I think it's kind of always something I wanted to do, but just maybe being fortunately in a tech hub, it was fairly easy for me to show up to events and kind of continue that more kind of older school kind of tactic. But I realized that you can show up as your authentic self digitally, and that resonates with people. And I think people are pretty good at telling kind of who's real and who's not.
Especially when Rob Hughes is part of the event.
Yeah, exactly. I mean, to that point too, like with your virtual happy hour group, like we're drinking tequila together. That's real, it's awesome. There's in so many ways, the last 13 months has removed a lot of barriers because we've quite literally entered people's homes. So it's not as stuffy as going and seeing someone at their office where, you're sitting in their waiting room. Would you like a water or coffee? And they're just these kind of weird formalities that you do. And then you kind of have a little bit of, let's find some commonalities, and then it's straight to the set, to what
Oh, those are your two kids running by you? Is that your,
it's just, it
is that Bryce's dog still sleeping on his bed after an hour?
yeah, I should start taking a poll though, but I'm convinced that it's still dogs over cats in the tech community. But yeah, so I think, even though it can be overload because there's so many virtual events and so many mediums now to take advantage of, I mean, it's so much more scalable, right? Because you can say yes to so many things, and you can identify folks that are the real deal, and what they are based upon actions, right? You can see the follow through, you can measure,
Got a little bit of a layer too. Like you said, like when we have those networking things, it's like 5 or 6 people or 12, but it's like, I don't know, it doesn't feel so stuffy, right? Like you said, you're drinking tequila, but it's like in your bedroom or your home office. And so
what I find fascinating is like through COVID, I found that it's actually expanded our reach. Like in a time where it kind of shut us in, it's actually been able to expand ourselves, because doing these virtual events where we may have just gone down to Providence and done an event, we're now talking to you in Texas.
Yeah.
We're now talking to people in California. We can tap into those markets that we probably would have.
And you can probably create more commonality, right? And so you're not limited to a pool of people in your area. You can kind of expand and
exactly. Yeah. It's ironic.
So.
And I know that accountants get a lot of shade of being a certain type of individual, but look at your competitive advantage just right here and now. Like, you guys are a future kind of forward shop, right? So you're immediately, showing that you've got a competitive advantage because of your willingness to hop on a live LinkedIn, session, or communicate with anyone across the country because you're agile as well. So I think that also comes back to kind of the marketing question of how is that scalable? How can you build more relationships? Well, you guys are coming in out as your authentic selves. You have value that's outside of, a day-to-day tax return, right? You talk about the things that people want to know about. And that's how you can really create real relationships, even in a remote world.
Yeah, no, I appreciate it. I would say one of my turning points in sort of our marketing, or how I viewed myself inside of our marketing strategy, it was 12 months ago. Corey turned to me and he's just like, you need to be more like Gary Vee. And I was just kind of like, I don't even know who the hell Gary Vee was. And then secondly, I'm like, I don't think so. Like, no, that's not me. Like I would have to, it would take me hours of preparation, and I'm pretty good at doing things on the fly, but you would just get nervous. You didn't know what to expect. And, that was a turning point for me personally. So
putting yourself out there more.
Putting yourself out there. And I enjoy this. Like I enjoy meeting new people, and I think this is scalable. And more importantly, I do agree. Like what we're doing right now, Ari, is we are giving people what they really need, right? So
yeah, and they tell you too. I think that's what's so neat about these types of forums too, is they were like, oh, I loved this. Like, I would love to learn about this. And now you've got your next content piece. It's pretty amazing. As a founder, you don't have to always be leading kind of what that content roadmap looks like. You can actually ask for it.
Yeah. The other thing that we've done is like we're experimenting more. So I think it was like 3 weeks ago when we were talking to you, you're like, oh yeah, we're using this video ask thing. And I was just like, okay, if she's using video ask, we're using video ask. John, go figure out video ask. And we're going to be posting up video ask on our website.
We're filming this afternoon.
We're filming this afternoon. So
good. Honestly, that has been our biggest lead magnet, our like lowest cost lead magnet that's provided us probably the highest return in the last 12 months.
Nice. This is videoask.com, right? That's their.
Yeah, it's a product by Typeform.
Okay.
And it allows you essentially to answer really kind of anything about your business or ask your customers questions. Quiz, you could use it for NPS score, client testimonials. It's kind of unbelievable. And now we're in a world where it's not a kind of obscure ask for someone even to just say, hey, can you just reply that way? You know?
Yeah,
So
totally.
it's cool.
So that's videoads.com. Check them out.
Yeah.
Cool. Well, I appreciate it.
No sponsorship here, but go
No
check it out.
I appreciate our relationship. I appreciate you, and I'm looking
Guys.
forward to our next networking event. And definitely, we should totally do Clubhouse, even though they're valued at $4 billion as of last week or something. We got to follow where our audience is. So
Yeah, definitely.
we
Yeah,
should,
they're hanging out there, living, breathing, and hang out. We've got to be there. So we'll definitely see you there next time.
Cool. Let's do it. All right, Ari. Thank you very much. I appreciate it.
Thanks, guys.
Thanks,
You too. Always a pleasure.
Pleasure.